Most people find out about this rule the same way. A letter shows up from Social Security, and their Medicare premium has jumped by almost $1,000 a year. Not because they did anything wrong, because of $1. Today, I'm going to walk you through the rule behind that letter. It's called IRMAA, and if you're on Medicare, or you'll be on it soon, the next 10 minutes could save you real money. Everything I'm about to share is general education, not personal advice, and every number comes straight from Medicare and Social Security's own published figures for 2026. I'll put the sources on screen as we go. So what is IRMAA? It stands for Income-Related Monthly Adjustment Amount. In plain English, it's a surcharge added to your Medicare premium if your income crosses certain lines. Think of it as Medicare's version of a higher price for higher earners. Here's the standard deal in 2026. Most people pay $202.90 a month for Medicare Part B. That's the normal premium. But if your income crosses $109,000 as a single filer, or $218,000 for a married couple filing together, your premium doesn't inch up. It jumps. One tier up, and you're paying $284.10 a month instead of $202.90. That's about $81 more every single month per person. For a married couple where both are on Medicare, that first jump costs over $1,900 a year. And here's the part that surprises people the most. This is a cliff, not a ramp. $1 over the line costs the same as $20,000 over the line. If the threshold is $109,000 and your income comes in at $109,001, you pay the full surcharge for the entire year. That is the $1 mistake. Let me show you all 5 tiers for 2026, because the jumps get steep. These are for single filers. Up to $109,000, you pay the standard $202.90. Over $109,000, you pay $284.10. Over $137,000, you pay $405.80. That's double the standard premium. Over $171,000, it's $527.50. Over $205,000, it's $649.20. And over $500,000, it tops out at $689.90 a month. For married couples filing jointly, double each of those income lines. And it's not just Part B. If you have Part D drug coverage, IRMAA adds a second surcharge on top, anywhere from $14.50 to $91 a month, depending on your tier. Now here's the second thing almost nobody knows, and it's the one that catches new retirees. Social Security doesn't look at this year's income. They look at your tax return from 2 years ago. Your 2026 premium is based on your 2024 return. Think about what that means. You retire this year, your income drops in half, and Medicare is still charging you like you're earning your old salary. Because on paper 2 years ago you were. Hold that thought, because there's a fix for exactly that situation, and I'll get to it in a minute. First, let's talk about what counts as income here. Because it's sneakier than your regular tax bill, the number Medicare uses is called MAGI, Modified Adjusted Gross Income. It's your adjusted gross income, line 11 on your 1040, plus your tax-exempt interest, line 2A. Did you catch that? Tax-exempt interest gets added back. Those municipal bonds you bought specifically because they're tax-free on April 15th. But they count against you for Medicare. Plenty of retirees have been pushed over an IRMAA cliff by income they thought was invisible. What else counts? Withdrawals from traditional IRAs and 401ks. Required minimum distributions. Roth conversions in the year you do them. Capital gains, including the gain from selling a house, a rental property, or a business. Pension income. The taxable part of your Social Security. Basically, the big one-time events of retirement life are exactly the things that trigger this. Here's the classic story. A couple sells the family home, downsizes, and pockets a healthy gain. 2 years later, their Medicare premium triples, and they have no idea why. Now you know why. So what can you actually do about it? 3 things. When is Horn? And the third one is the good news almost nobody uses. First, know where the lines are. If you're taking money out of retirement accounts and you have any flexibility on timing, those bracket numbers matter. Pulling an extra $15,000 in December versus January can be the difference between standard premiums and a surcharge tier. Many retirees and their tax preparers plan withdrawals around tax brackets, but forget the IRMAA brackets entirely. They're different lines. Second, if a big income event is coming, plan which year it lands in. A Roth conversion, a property sale, cashing out an investment. You can't always control these, but when you can, bunching them into 1 year instead of spreading them across 2 can mean you take the IRMAA hit once instead of twice. Some people do the opposite and spread a conversion across several years to stay under the lines. Which way is right depends on your numbers. And that's a conversation for your tax professional. The point is, the timing is a lever, and most people don't know the lever exists. Third, and this is the one I really want you to remember, if your income has dropped because of a life change, you do not have to wait 2 years for Medicare to notice. There's a one-page form called SSA 44. It's free, it's on Social Security's website, and it exists for exactly this situation. The form covers what Social Security calls life-changing events. Retiring or cutting back work hours is on the list. So is the death of a spouse, divorce, marriage, loss of a pension. If one of those happened to you, and your income is lower now than it was 2 years ago, you can ask Social Security to use your current income instead. People who qualify can erase the entire surcharge, not reduce it, erase it. If you took nothing else from this video, take that. If you retired recently and your Medicare premium still reflects your working years, look up Form SSA 44. It's the most useful piece of paper most retirees have never heard of. One last thing that should take the sting out of all this. IRMAA is recalculated every single year. One expensive year is not a life sentence. If 2024 was a high-income year for you and 2025 wasn't, your premium comes back down in 2027 on its own. The system resets. Let's put the whole thing in 1 minute. Medicare premiums jump at hard income cliffs, and $1 over costs you the full surcharge. The lines for 2026 start at $109,000 single, $218,000 married. They look at your income from 2 years ago, not today. Tax-free bond interest counts. Home sales count. Roth conversions count. And if your income dropped because life changed, Form SSA 44 can fix it now instead of 2 years from now. These numbers change every year, and your situation is your own. So before you make any moves, sit down with a tax professional who knows the IRMAA brackets, not just the tax brackets. If this was useful, the next video covers the window between retirement and age 73, where smart Roth conversions can lower your taxes and your Medicare premiums for the rest of your life. Same plain English, same sources on screen. I'll see you there.